In the past, we have done these ranking videos where we look at a certain number of stocks and rank them based on quality. Again, this is completely based on quality and less on valuation. However, we will look at today's valuation as well. In those prior videos that I speak of, we covered REITs in one of the videos, and the other video we covered Dividend Kings. And in today's video, though, we are going to cover 5 dividend growth stocks, ranking them from highest to lowest based on quality. Now, I consider a dividend growth stock a company that has continued to increase their dividend for 10 consecutive years and a company that has a 5-year dividend growth rate of at least 10%. So if you love dividend growth stocks, then you're really going to love today's video. But before we begin, do me a huge favor and click that like button down below, as it really helps us spread the word and grow the channel, and I truly appreciate it. And subscribe to the channel so you're notified anytime we drop new content. And with that being said, now that you've had a chance to do that, let's jump into the video. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. If you're someone that has watched any of my prior videos, then you know I love dividend stocks. I don't just invest in dividend stocks. I do have growth stocks that don't pay any dividends, just for your reference, but I love, and the majority of my portfolio is made up of dividend-paying stocks, or ETFs. So with that being said, I need something that is going to track all of these dividend payments. How much am I getting paid on an annual basis, and break that down into a monthly basis. Let me introduce to you Snowball. Snowball is a simple and powerful portfolio tracker. You're able to keep all your positions in one place, which is quite helpful if you're like me and have multiple brokerage accounts. For me, I use Fidelity, Vanguard, as well as Webull. With Snowball, you can track or watch stocks and ETFs from all over the globe. And this tool is user-friendly for those both inside and outside the United States. One of the cool features that I like is the dividend calendar, which adds up all of my dividend income and puts it into a nice chart by month so I know how much I'm getting paid and when I'm getting paid. Snowball also provides detailed dividend analytics, which help you monitor your current positions, but also helps you research future positions as well. Oh yes, and I have to mention, of course, Snowball has AI capabilities. So if you're ready to use this amazing tool, check out the Snowball link down in the description below and get 14 free days. Give Snowball a try today. Now back to our video where we're going to take a look at 5 dividend growth stocks and rank them based on quality. Now when I talk about quality, I'm not, again, focused on valuation per se. When I talk about quality, we're looking at things like the balance sheet. We're looking at management and how efficient they're run. We're looking at the growth and the trajectory of revenue as well, among other things. So to begin, how about we start by going over the 5 dividend growth stocks that we're going to look at today. One being Home Depot, another being Costco, third being Starbucks, fourth being United Parcel Service, and the fifth being Abbvie. We will rank all of these stocks and put them into 4 different categories. The first being must own. And when I say must own, this is pretty self-explanatory, as these are the highest quality stocks. The next segment is high quality. This is a solid company and stock and a great fit for most portfolios, but not necessarily a must own. The next segment is like but not love, and I like to call these companies, they're solid companies, but they could falter from time to time. You may find them in my portfolio here and there, but they tend to have more short-term stays within the portfolio. And lastly, these are my prefer not to own stocks. These are companies that run into issues more than average and ones I tend to shy away from, and you will not find these in my portfolio. So with that being said, let's begin with our first stock, which is the Home Depot, stock ticker HD. The Home Depot, as many of you know, is the largest home improvement retailer here in the US today, operating in a duopoly with the likes of Lowe's companies. Currently, Home Depot has a market cap of $332 billion, and over the past 5 years, shares of Home Depot are up nearly 70%. One of the great things I like about Home Depot, outside of shopping there, is the fact that they're continuing to evolve. Even their online sales continue to increase. but they're also immune from outside e-commerce threats like Amazon. Not too often are you going to buy a 2x4 or sheet metal or even appliances from Amazon, especially appliances. You like to touch, feel, and see these things. And after all, Home Depot matches the prices that you can find online. Looking here at the Snowball Tracker, you can see that Home Depot pays an annual dividend of $8.36 per share, which equates to a dividend yield of 2.55%. The next ex-dividend date is August 31st. So in order to receive the next dividend payment, you need to own shares before this date. Home Depot also has a low payout ratio of 47%. The company is very well run, and you can see here how the company has increased both revenues and net income over the years. Now let's take a look at dividend growth, which is key in this process that I talk a lot about of the power of compounding dividends. So now pulling back up the dividend dashboard within Snowball, we can see that the Home Depot has grown their dividend by 10% over the past 12 months, nearly 12% over the past 3 years on average, and 15.2% over the past 5 years on average. So dividend growth is certainly slowing, but I don't think anyone can expect 15% dividend growth rate forever. Home Depot has increased their dividend for 13 consecutive years and counting. And with that being said, now let's take a look at valuation. Analysts are looking for EPS of $16 flat next year, which equates to a forward price to earnings multiple of 20.5 times. Over the past 5 years, shares have traded at an average earnings multiple of 21.5 times. And over the past decade, closer to 22 times, so a slight discount at current levels. So now when it comes to ranking, and again, I love Home Depot, the stock and the company, love shopping there, could spend hours at a Home Depot store. But when it comes to ranking the stock in terms of quality, I rank Home Depot as a must-own. They have a great management team that operates at a very efficient rate. They print money in terms of cash flow, and they return it to shareholders, both buying back stock and growing their dividend. The next stock we're going to look at is Abbvie, stock ticker ABBV. Abbvie is actually one of the longest positions I have held in my portfolio, and I've sold some of those shares, which has increased my cost basis. But I bought Abbvie first back around the low $60 per share range. Since then, the stock has moved up over $140 and $150 per share, so we've seen some nice gains along with some great dividends along the way. Looking here at the Snowball Tracker, you can see how over the past 5 years, shares of Abbvie have risen by about 51%. And that, again, does not include all the dividends that have been paid along the way. The company currently has a market cap of $264 billion. Abbvie has been their own public company for about a decade now, as they were initially a spin-off from Abbott Laboratories. But now when you look at Abbvie and the growth they have seen since becoming their own company, they now have a higher market cap than Abbott Laboratories. The company is most well known for their drug Humira, which was the #1 selling drug for a number of years. But at the start of 2023, that drug lost its patent protection. So with that, we expect revenues to come down for that particular drug, but the company has a loaded pipeline of new and up-and-coming drugs, which are supposed to take that torch moving forward and add growth to the company in a few years. Abbvie pays an annual dividend of $5.92 per share, which currently equates to a dividend yield of nearly 4%. The dividend is plenty safe with a payout ratio below 50%. Abbvie has increased their dividend every year that they've been a public company, and they have a 5-year dividend growth rate of 12.3%. Now let's take a look at valuation, where analysts are looking for EPS of $11.06 per share next year, which equates to a forward price to earnings multiple of 13.5 times. But the thing that investors are starting to take note of, and management has made clear, is that those new drugs, Rinvoq and Skyrizi, are expected to keep growing, but reach premium levels not for a few more years, which is why you see analysts go from no growth in the next year to 10% EPS growth the following year. Over the past 5 years, shares have traded at an average earnings multiple of 11.4 times, and over the past decade, closer to 13 times, making the stock look fairly valued at current levels. So now when it comes to ranking Abbvie, again, in terms of quality, I have a lot of love as I have owned the stock for a number of years now. But again, they lost patent protection. They're going through this transition phase. Now, I know the management is telling me that Skyrizi and Rinvoq are going to carry the torch, but it's something that I have to see. Again, I'm going to keep holding the position. It's still one of my top 10 positions in my portfolio, but for that reason alone, I'm going to drop them down from a must-own and put them in the category of high quality. The next stock we're going to look at on our list is United Parcel Service, stock ticker UPS. Now, UPS is one of the largest logistics company in the world today. The company currently has a market cap of $131 billion, and over the past 5 years, shares of UPS are up 48%. But if you look at over the past 2 years, really, the stock has really been trading sideways. UPS has been more in the spotlight of late as they've been going through a labor fight with many of their union workers. But they came to an agreement recently with a union called Teamsters, which is really going to increase the labor costs for the company, but it should be a big relief to many of those union workers as well. That union deal is really going to increase those labor costs, which is really going to negatively impact the bottom line for UPS moving forward. Now, businesses aren't shipping more or less just based on UPS coming to a labor agreement with their Teamsters union. As such, I believe a lot of this wage increase is going to result in higher prices for consumers or businesses trying to ship with UPS. And that could be a big win for the likes of FedEx, DHL, or any other logistics company. Many analysts have come out in recent days downgrading the stock as the increased labor costs will certainly weigh on the bottom line. In terms of the dividend, UPS pays an annual dividend of $6.48 per share, which currently equates to a dividend yield of 3.6%. The dividend is plenty safe with a payout ratio below 50%. UPS has increased their dividend at an average annual rate of 12.2% over the past 5 years, making them a dividend growth stock. How the increased labor costs, though, will impact dividend growth moving forward will be interesting. The company has increased their dividend for 13 consecutive years. Now let's take a look at valuation. Analysts are looking for EPS of $11.56 per share next year, which equates to a forward price to earnings multiple of 15.6 times. Over the past 5 years, for comparable purposes, shares have traded at an average earnings multiple of 15.5 times, which is right spot on where they're trading right now, meaning shares appear fairly valued. So where do we rank UPS? This labor deal is really going to weigh on the bottom line, and they have competition from the likes of FedEx, DHL, and many other logistics companies that are up and coming, not counting Amazon, who continues to grow their logistics fleet as well. As such, I'm going to rank UPS in the prefer not to own category for this reason. The next stock on our list is SBUX Corporation, stock ticker SBUX. Like Abbvie, Starbucks is another name that I've owned in my portfolio for a number of years. One of the first things that I learned early on in my investing career was invest in what you know. Well, I knew Starbucks quite well because I frequently visited the stores on a regular occurrence. As many of you already know, Starbucks is the premier coffee chain across the globe, with their two largest markets being in the United States as well as China. The company currently has a market cap of $115 billion, and over the past 5 years, the stock has risen nearly 90%. However, over the past few years, Starbucks has ran into some troubles with the pandemic as well as slowing growth over in China. But otherwise, the company has been fantastic. One of the great things about Starbucks is their loyal customer base, as they have more than 31 million rewards members in the US alone. And again, these are active members, meaning they have purchased something in the past 90 days. Over the years, Starbucks has transformed themselves into much more than just a coffee chain. They have merchandise, they have food options, they have reserve roasteries, different varieties of drinks, both hot and cold, as well as coffee and tea, and much more. There's something special psychologically for consumers when they carry around that mermaid coffee cup that makes them feel empowered or special. What this has done is resulted in the company printing huge amounts of cash flow, which has resulted in large amounts of dividend growth. Speaking of that dividend, the company currently pays an annual dividend of $2.12 per share, which equates to a dividend yield of 2.1%. The company has a 5-year dividend growth rate of 12.5%, firmly making them a dividend growth stock. Now for valuation, where analysts are calling for EPS of $4.08 next year, which implies 18% EPS growth after a year in which they expected to generate 17% EPS growth. So the company is still fully in growth mode. This has the stock trading at a multiple of 24.6 times, which is above the market multiple, but that is due to the fact that they are expecting this high double-digit EPS growth each of the next few years. Over the past 5 years, for comparable purposes, shares of Starbucks have traded at an earnings multiple of 31 times, which is in line with their 10-year average as well. So where do we rank a company like Starbucks in terms of quality? Again, this is a stock that I have owned for a number of years. They are a fantastic company, but they can be volatile at times, and they do rely a lot on the China growth story, which has been failing to pick up here in recent years. So with that being said, we're going to drop down Starbucks from must own, and we're going to put them in the high quality bucket. The fifth and final dividend growth stock on our list is Costco Wholesale, stock ticker COST. We're going from one loyal customer base to another loyal customer base. And again, if you like these videos and you enjoy these ranking videos and want to see more of these, definitely let me know down in the comment section below. So as I mentioned, Costco has a very loyal customer base. And the thing is, they also have a high renewal rate in the high 90 percentile. So when we were talking about Starbucks, we were talking about 31 million rewards members. Again, that was just in the US. When we look at Costco worldwide, they have nearly 125 million cardholders. That is incredible to think of, with 86% of their stores being here in North America. Costco currently has a market cap of $247 billion, and over the past 5 years, the stock has grown by nearly 150%, making them far and away the best performing stock on our list today. So I'm sure you can see where this headed. When it comes to Costco, or even Home Depot for that matter, I can spend hours inside of this store, and the company does a great job moving things around on almost a monthly basis. It can be frustrating from a shopper's standpoint, but they're really forcing you to go down each and every aisle. And tell me down in the comment section below, how many times have you gone to Costco and bought something that was not on your shopping list? When it comes to the dividend, Costco's not known much for their dividend yield, but they do have strong dividend growth and share price growth, as we've seen. The company currently has a dividend yield of just 0.73%, and they have a 5-year dividend growth rate of 12.4%. Costco has increased their dividend for 18 consecutive years and counting. The other unique thing about Costco is the fact that they have started regularly paying a special dividend, which is always a nice surprise for investors towards the end of the year. Now turning our attention over to valuation, where analysts are calling for EPS of $15.49 per share next year, which equates to the slowest EPS growth since 2016 for the company. This has the stock trading at a forward earnings multiple of 35.9 times, which is above their 5-year average of 32 times. Below 30 times is where I would love to see this stock again, which would mean a price point of around $460 per share. In terms of ranking Costco, the valuation is one thing, but in terms of quality, this is far and away a must-own dividend growth stock. Again, I could spend hours there. The company is very efficient, and you have to be, as it's a low-margin business. But a 90% plus renewal rate is unthinkable, and the company continues to grow their rewards members, their cardholders, each and every year. And then on top of that, although they have a very low yield, they have strong dividend growth, but they're also providing strong share price growth opportunity as well, giving you that full total return potential. So to recap the video and go through the qualities one more time, our must-own stocks are Costco as well as the Home Depot, two of my favorites to shop at, so I may be a little biased. Our high-quality stocks include Abbvie and Starbucks, two positions that I've held the longest. We didn't have any like but not love, but we did have one prefer not to own, which was UPS, and how that new labor deal will weigh on the bottom line and really force the company to increase prices, which are going to be passed on to businesses and, yes, you, the consumer. So with that being said, down in the comments section below, let me know how you would rate these 5 dividend growth stocks. And again, I hope you enjoyed the video, and if you haven't done so yet, smash that like button down below, as I truly appreciate it. And with that being said, we'll see you in the next video. Take care.